To begin?
I think we should begin. So I think we've got a good number. So good morning, everyone, and welcome to the fifth of these Oury Clark webinars. We are live. There is one now at 8 o'clock, and we're doing another one at 4 p.m. So the way things flow might be slightly different. But anyway, welcome everyone. To those of you in the UK, thanks for joining us early. And for any of our international guests in the Southern Hemisphere, I hope you've had a good day. I'm joined today by 8 of my colleagues, and so we've got quite a bit to get through, but I'll just get them all to say hello and introduce themselves, and then we can, I'll talk a little bit about some housekeeping. Andy, do you want to kick off?
Oh, hello everyone, Andy here.
Juliet.
Morning, Juliet here.
Ian Phipps.
Good morning, Ian Phipps.
Ross.
Good morning, everyone.
Rachel.
Good morning, everyone.
Andrew.
Hi, morning.
Casey.
Hi, good morning.
Jemma.
Morning, everyone.
And me. So how things work, just a little bit of background for those of you who don't know us. We're Oury Clark. We're a multidisciplinary professional firm with offices in London and the southeast of England, primarily out near Heathrow Airport. And what this means, so essentially we're a bunch of lawyers and accountants, and we work together helping our clients as best we can. We also have access to other specialist expertise, most importantly in these COVID times, access to medical services. Andrew Thomas, who you hear from later, runs our financial services team and looks after all things in relation to employee benefits and pensions and wealth planning and those sorts of things. We have a recruitment arm, we have an insolvency team, and a very, very nice bunch of other people. What we're trying to do through this series of webinars is provide some guidance and help our clients distill information that has been flying around thick and fast, and in many cases with not a great deal of clarity. But what we're going to do over the next hour is we'll work through a number of areas that are quite topical. Some of the slides will be more detailed than others. And then we will do a Q&A at the very end. So feel free to pose any questions. I'll moderate the Q&A and hopefully we'll be able to address most all of your questions. If we don't get to them, then we will actually circulate answers to your questions at the end of the day after both of these webinars. This is, as I said, this is number 5. You can actually find all the previous 4 editions on our YouTube channel. This is being recorded and will be available. So I'm just going to kick off and just talk a little bit about Rishi Sunak. Rishi, for those of you who don't know, Rishi is our treasurer. He was due to hand down an autumn budget in early November, but in light of the continuation of the COVID crisis, he ditched the budget and has come up with a package of measures to hopefully continue to help businesses of all shapes and sizes throughout this crisis. And many of these measures move into next year. So even though I'm a lawyer, I've been given the great honor of talking about things in relation to tax and a couple of other things. But essentially, Rishi announced that there is a bunch of tax cuts and deferrals. The 2 main areas are that the VAT rate in the UK, which is normally 20%, was reduced down to 5%, so 15% reduction for businesses in the tourism and hospitality sector. And that has been extended to the end of March next year. As with most of these things, it's been slightly difficult trying to work out exactly who that relates to, but you'll see at the 3rd paragraph on that slide, it's primarily businesses in the hospitality sector, restaurants, bars, cafes, and similar premises, as well as accommodation facilities and tourist attractions as well. So they all get the benefit of that reduced VAT rate right through until March next year. And essentially, it applies to deposits as well. So, for example, if you've perhaps made a block booking for some accommodation, and that accommodation is not due to be delivered until May next year, then even though the VAT rate may well go back to its normal rate, you'll still get the benefit of that reduced rate. And certainly Her Majesty's Revenue and Customs won't be able to come and chase you for that, as they have done in the past. Interestingly as well, they've also given businesses the opportunity to defer their VAT payments. This isn't actually on one of the slides, but rather than having to pay your normal VAT return at the end of March next year, over the 2021-22 financial year, the government has put in place a plan that gives small businesses or any businesses the opportunity to repay your VAT in 11 equal instalments over the 21-22 financial years. So certainly a very good initiative to help from a cash flow perspective anyway, for VAT registered businesses. The Chancellor also announced a measure of packages to help self-employed people. So there has been an extension on the time to pay facility for people who are self-employed and have different tax obligations through the course of their self-employment. And slightly along similar lines to the VAT deferral scheme, you can pay tax in 12 monthly instalments for the period of February 2021 to January 2022. If the VAT that you owe is if the tax you owe is less than £30,000, then you can just do everything online. If it's more than £30,000, then you will have to speak to HMRC. As many of you are probably aware, the government announced a whole bunch of loan initiatives at the very beginning of the COVID crisis or during the COVID crisis, and there have been a number of it. In fact, all of them have been extended. So the three most common that we're seeing are CBILS, so that's the Corona Business Interruption Loan Scheme, the Bounce Back Loan Scheme, which was for smaller loans up to £50,000, and also the Future Fund. So all of these schemes have been extended, and under the announcements made, there have been some relaxation in the payment terms. So the Treasurer has worked with British Bank to provide smaller businesses with much more flexibility around the repayment terms of their loans. So essentially, you're able to extend the life of those loans, and you're able to manage your repayments more effectively. A point worth noting is that the Future Fund, whilst it was quite late in being announced, it is still, they are still taking applications, and essentially it's proven to be a very, very effective way of businesses securing money from the government, particularly if they were going through or thinking about fundraising themselves. So it's one of those schemes that requires you to have private investors commit to matching funds from the government. And having worked with a number of our clients through the application process, it is reasonably straightforward. It's just that there's just quite a bit of paperwork, but it's nothing too onerous. So if you haven't taken advantage of the Future Fund and you've got private investors who might be interested in putting in money, then you should take a look at it. One of the other announcements that the government made is that they're going to continue to invest heavily in public services. Whether that translates to spending in health and those other areas, we're a little bit unsure about what that looks like, but certainly the government is committed to creating job opportunities within the public sector, and certainly with some very, very big infrastructure projects. And of course, HS2 will go ahead. For those of you who don't know, HS2 is another major rail infrastructure project. The government committed to what is known as Crossrail, which is essentially an east-west high-speed train across London. HS2 will be a north-south high-speed train that will go from Croydon in the south right through London and then up to Birmingham. So the travel times for commuters between London and Birmingham will be significantly reduced. And with sort of the move to more flexible and agile working, those high-speed rail links will certainly be very, very valuable and an effective way of moving people around. So That's all I want to say about the winter packages. I'm now going to hand over to my colleagues Ross and Casey, both of whom are lawyers in our employment and immigration team, and I will get them to talk about the job support scheme and returning to work. Over to you. Thank you.
Thank you, Simon. If you can move on to the next slide, I'll talk to you about the job support scheme. What is it? It's a new support package to replace the furlough scheme. The furlough scheme ends at the end of this month, and the job support scheme will run from the 1st of November for the next 6 months. What's the difference? The key difference is that the furlough scheme was more keeping people in jobs that didn't exist anymore during the COVID pandemic. This one is more about keeping people in viable jobs, but that were the jobs and the downturn in business has forced people to work fewer hours. That's what it's all about. And in a nutshell, this is how it works. The employee has to work a minimum of 33% of the normal working hours. Whatever hours they work, the employer has to pay for those hours. Then in terms of the unworked hours, it's split between the government and the employer. The employer will pay a third of the unworked hours, and then the government will pay a further third of those unworked hours, but that's subject to a cap of just under £700. The remaining third is given up by the employee, subject to their agreement. And that's the key here, guys. The key is you've got to agree this in writing with the employee. You've got to confirm the changes to their employment contract. Otherwise, you're going to end up with unlawful deduction from wages claims and breach of contract. It's just not going to work otherwise. Next slide, Simon. Just touching on the eligibility a little bit more, employees have to have been on the PAYE payroll on or before the 23rd of September 2020. And there's a catch here, as it was with furlough at the beginning. And the catch is this, is that also real-time information has had to have been submitted to HMRC by the employer before that date. So what that means is if you've got an employee who joined you in September that you think would have been eligible for this scheme, if you pay them a month in arrears and the real time is submitted at the end of the month, they're going to miss out on this. As I mentioned, there's a minimum requirement of 30% of their usual hours. What the government has said is that will apply for the first 3 months. After 3 months, the government may increase the minimum hours threshold, and each grant claim must cover a minimum period of 7 days. Next slide, please. In terms of employers, the key is having the PAYE scheme, but also a UK corporate bank account. Now, I know that some of our clients do not have UK corporate bank accounts because it's a bloody nightmare getting a bank account open. And I could rant all day on this, but the thing that we found in furlough, and I'm sure this is going to apply to this new job support scheme, was that if we run your payroll, our client account can count as the bank account. So I think that it is possible. The main target here for employers is SMEs. Larger businesses could be allowed to participate, but they're subject to a financial assessment test, but it's really SMEs. And my last point on the slide, which you can read through later, is more to emphasize again, you must agree in writing with the employee the changes. Otherwise, it's just not going to work in practice. I've covered what the grant covers. As I mentioned, worked hours paid by the employer, unworked hours a third paid by the employer, and then a third paid by the government subject to this cap. What it doesn't cover is the Class 1 employer national insurance contributions or pension contributions. They've got to be payable by the employer. And unlike furlough, you can't recover the grant for employees you're making redundant. That's a key difference from the furlough scheme. How can you claim? There will be a government portal set up by December and the grants will be payable in arrears. And just to emphasize again, the HMRC will look at abuse of this as they have done for furlough. So do not abuse. I've then finished off with an example. Boris Janssen, any similarities to names of people living is purely coincidental here. But my question to you, you can read through the example at your leisure. Would you keep Boris in a job? That's the question here. My feeling is that most employers will look at this scheme and say, it's not for us. We're going to we might as well make this person redundant. There's not enough hours for this person if they don't agree to a reduction in the hours. Because if you look at what the employer ends up having to pay, I think it's off-putting. And I mean, for example, in the table I provided, if the employee is working 33% of their normal hours, the employer cost of normal wages, and then you've got the pension and employer and national insurance contributions on top, is 55%, and for 40% it goes up to 60 and so on. I don't think this scheme will be taken up. Maybe I'm wrong. Maybe a flip side to this is that employees in senior roles that you want to keep because you know that the winter months you'll recover from the winter months. You want to keep key people. Maybe you'll look to use this scheme for those employees. But the general consensus is it's not a great scheme. It's political spin by the government. Now, Casey, I'm going to pass to who will talk to you about return to work.
So return to work, but don't, if you're able to work from home, then do, but do come into the office if you can't. So that was essentially the guidance that was given by Boris, which is of course very clear. So today I just want to give you a bit more advice of what we think he actually means. So what we think is clear is that office workers who can work from home effectively should do so, and anyone who cannot work from home should go to their place of work. So how do you even begin to decide this with your employees? I advise that employers should, in consultation with each employee, determine whether that employee can carry out their normal duties from home effectively, and if they can, then they should work from home. However, where it is determined with that employee that they cannot work from home, then subject to any health conditions such as serious health issues, you can then ask them to work from work. Employees who are clinically ill or extremely vulnerable can go to work if it is COVID secure, but again, they should carry on working from home where possible. So that is what we think of what he means by his very clear message. But must you stop planning your return to office plans? Our answer is no. As an employer, you need to assess whether an employee's job requires them to be in the office or not, or if they are working from home, are they carrying out their duties effectively or not? Next slide, please. So how do you approach your staff with this information? It is not a one-size-fits-all approach, and I think that is key. You need to think carefully about requiring employees to come to the office if they can otherwise do their job effectively at home. Consider why it is necessary that they come into the office. You may say that your business is struggling to manage various teams or supervise staff virtually, or maybe in the way in which your business runs is dependent on collaborative workspaces. And these are absolutely legitimate business reasons for you requesting employees to come back into the office. But you should think about whether these concerns can be addressed in another way. For example, we're seeing a lot more people do regular virtual check-ins with your teams and things like that. So consult with your staff. Ask them questions and address their concerns about returning to work. Working from home over a sustained period of time can have a serious impact on employees' mental health, which in turn will affect their productivity at work. So perhaps it is beneficial that they do come into the office, but these are the type of conversations you need to be having with your employees. Discuss their performance that they have been having over the last 6 months and whether it is viable for them to continue working from home or whether returning to the office is better. So we would say that consider putting people on a return to work rota if you are thinking of bringing them back to the office. This has been a huge thing that most of our clients have been doing. It's a common approach as on the basis that if one group becomes ill, you still have a functioning business rather than all employees being off sick. So assess the employees working from home and assess their living situation. Consider whether they've got clinically vulnerable, consider whether they are clinically vulnerable or whether they live with vulnerable people. Our main takeaway though is discuss these things with your employees. So our next slide, I won't go through every question that's on the slide, but these are just some examples of what you should be discussing with your employees or ways in which you can find out how they are thinking about returning to office or their health considerations. But I think what is important for you to think about is a long-term contingency plan. The government has said has indicated that the current restrictions could be ongoing for at least 6 months. So do you have the technology and infrastructure in place for your business to continue working from home for 6 months, or is it time for you to start bringing people back to the office? I will now introduce our lovely Andy and Juliet to chat about the topic, our favorite topic that was big in the headlines before we were all distracted by COVID, Brexit.
Thanks, Casey. Brexit, is happening. And you could take the view that maybe we're going on a course of sort of Singapore on steroids, seeing as Singapore seems to be very much a competitor to us when you really look at businesses and tax and structuring. But certainly in the short term, it might be a bit banana republic on life support with no bananas. It's certainly going to be a little bit chaotic. 1st of January, I mean, obvious point, but that's when it's happening. The good news is the legal and technical impact of Brexit. I think this really surprises people when you really get into it. There's many questions we've answered with no effect, no effect. It has a very limited effect in technical legal terms, you know, in regard to tax and in regard to sort of, but there are effects, and we're going to try and just cover them very quickly, although it's relatively complicated. And of course, we don't have a deal yet. Will we have a deal? Don't know. We kind of got to go on the basis that perhaps not. So one big effect is VAT. That is the one thing. We're leaving the customs union. So does it affect you? If you are selling B2B services, basically you're fine, is the short version. There won't really be a change to anything. If you're selling B2C services, now this is often technology companies selling digital services, you know, through SaaS platforms, things like this. Yes, it can affect you if it's B2C, which is probably the minority when it comes to things like that. After the 1st of January, we do not have access anymore to the distance selling thresholds. Basically, at the moment, if you register in one European country, like the UK used to be, you get a 35,000 to 100,000 euro limit for B2C services or goods, but the distance selling threshold allows you to sell that much in all of those other countries. The threshold varies per country. Almost everyone is 35,000 euros, but the UK and Germany are 100,000. So that's gone after the 1st of January. There is what's called, some of you may be registered for it, the MOS scheme. The MOS scheme is a single registration for digitally supplied services. Again, if you're using a UK MOS scheme, when we leave on the 1st of January, it doesn't work anymore. You need to re-register for a non-union, i.e. we are not in the European Union MOS scheme. So if you supply services B2C to other European countries, and if you want to access distance selling thresholds, you don't need to set up new companies, but you do need to get a VAT registration in Europe and use that in some way to supply your services. It's worth making a side note. I'm going to go quickly through this because it will only affect some people, a lot of these slides about sort of B2C, but financial services. There is a passporting regime that we're leaving, obviously. There is the temporary permissions regime the British government have. They reopened yesterday. So if you're a European company and you want to sell financial services into the UK, you can register again now on this scheme, and the UK will allow you to do so. There is not a reverse scheme. So there is nothing being offered by the European Union. And if you haven't already got ahead of yourself and registered in the European Union to continue to try and supply services there, at the moment you are too late, and you will have to start a completely fresh application, which could take you 6 months. The big banana is selling B2C goods. This is sort of the thing that will affect most people and is the most sort of obvious and clear impact of Brexit. No more distance selling thresholds. If you are moving goods from the UK into Europe, you are exporting out of the UK and importing into the European Union, you need to pick a new port of entry in the European Union. I mean, that's generally the places on the coast. So that's Germany, Holland, Belgium, you know, Antwerp and Rotterdam and these ports. But you've got to get registered somewhere where you are physically going to move those goods. You can have a UK company and you can register for VAT in, say, Germany. And that does mean you can ship direct China to Germany It's your UK company, but it is a VAT registration in Germany. You're importing into Germany. And then from Germany, you can access the distance selling threshold across Europe. Now, there's a concept called fiscal VAT representation. Most countries require you to have a legal representative in their country to register for VAT in that country. In short, it makes it more expensive. Certain countries do not: UK, Ireland, Germany, Czech, France has now joined the bandwagon, and Malta. So in those countries, you do not have to pay for fiscal VAT representation. The most popular place to move goods into is Holland, but I would flag up to you that Holland is not a great place to form a company. It takes forever. And also, if you look at what's going on with Unilever, you know, if you Google that, you know, they're moving lock, stock and barrel to London because Holland's introducing quite a nasty tax for foreign-owned companies. So you don't have to get companies is the point. You just need to register there. If you are importing goods from Europe, okay, you would think that that's not a problem. And some companies, or a lot of companies, do that. It is a problem because you require there's an Oury number. You probably have an Oury number if you're in goods. I'm sure you do. And that will be a UK Oury number. Well, you've got to get yourself an EU Oury number if you want to import goods from Europe. So export out of Europe or import into Europe, you need an EU Oury number. Also, everything's going to change, by the way. So in Europe, all the rules are changing from the 1st of July, although it's been delayed once and it might be delayed again. They are abolishing distance selling threshold. So they're all going anyway, introducing a new £10,000 threshold, and they're introducing a one-stop shop for goods. This is good news. You can have one registration and you can sell goods across Europe. If you're a UK business, you can do that if you have an EU VAT registration. So that's coming down the path. What's going on with the UK? The UK have done a load of things. This is actually sort of good news, some of this, I guess. It's introducing postponement. So when you import into the UK, you no longer pay VAT at the port. You pay it through your VAT return like you do in Holland. There's phase 1, which is January to July, which they will allow the deferment of all payments of VAT until the 1st of July, duty as well. So not excluding alcohol and tobacco. Then basically they keep bringing in regulation after that. It keeps sort of phasing in till July till you've got to do sort of full declarations to come into the UK, as it were. EU is also introducing a £135 rule. So you can sell something across Europe. If it's less than £135, then you basically don't have an issue about registering for VAT there. Other changes are the EU VAT refund scheme is going for the Britain in terms of the moment you can do it through a UK VAT return. You can claim any VAT suffered in Europe. Sorry, can't do that anymore. Got to use the 13th directive. And it's bloody slow, like take you a couple of years to get your money back. Now over to my sister on visas.
Andy, thanks. So I've been past the global hot potato of immigration, my favourite subject. I've got 2 minutes to explain it. So Brexit massively impacts the movement of people. That is the bottom line. We will no longer have free movement from the 31st of December 2020. So this Christmas, get everybody in before that date. That means if you're entering post as a European or you're a Brit, we're going to need visas, and that is going to take time. So we're going back in time like we used to. We used to have visas, and the immigration policy is a minefield, and each European country, I'm sure, is going to do a very different thing. So we'll have to see. As for the UK, if you have Europeans in your workforce, if you're thinking of having them or you're European and wanting to come to the UK, get here before the 31st of December. Please get your talent in before that date. If you currently employ EU nationals and they are here, either they're going to enter before Christmas or they're currently here, please ensure that they apply for the EU settlement scheme. It's free, it's simple, it's straightforward, it's an online application, but they must do it. That process closes next June, so the applications must go in before then. if you are looking at wanting to bring in Europeans post the 31st of December, you are most likely, because they're going to need a visa, we have yet to know what the rules are going to be, but it is likely that they're going to need to be sponsored. So under our tier 2 sponsor license system. So the big tip is please get a sponsor license now, apply now. It can take a few months. So the sooner you apply, and if you think you're going to need Europeans, please apply now if you do not have a sponsor license. Then we await basically what the systems will be. And as soon as we know, we will let everybody know. But they will be amending, and they are amending the sponsor license system. So wages will come down. There won't be caps and things. So it should hopefully be more straightforward. My final beg point is please make sure that you check all your staff's immigration status, even if you think they're a Brit. Please ensure that you get everybody's copies of their passports, have a look at them and make sure they've got right to work checks. So ensure that they have permission to work. Failing to do that, and if an illegal worker is found, it is £20,000. And the government is definitely looking at doing a bit more of that to bring back in some money. So please make sure right to work checks are done on all staff. Andy, I'm handing back to you for some
I'm
more
really
technical...
sorry, there's a little bit more Brexit. So this is the non-VAT Brexit. We're going to rush through it, but these are the other technical effects of Brexit from a tax point of view. The EU has something called the Parent Subsidiary Directive. It means that any company can pay a dividend without withholding tax, and when the other company receives that dividend, it's not taxed. That's going, but the UK, that is standard in the UK. There is no withholding taxes on dividends in the UK, and there is no tax on received dividends. So from a UK point of view, you're fine, but you may not be fine anymore from the EU point of view. It's sort of similar with interest and royalties is another thing that says we won't tax them basically. Again, that's enshrined in UK law. That's how we do business anyway. We've confirmed that we're not going to do it, but others might. The merger directive, which I hope you've never bumped into, but allows you to reorganize companies in Europe and in theory, reduce, charges, but it's pretty hard to do, pretty complicated stuff. So I'm not sure many really truly benefit from this other than perhaps very large companies. Really, other than that, we won't be in state aid anymore. That's an R&D thing. That's any sort of government funding, maybe we will out of the deal, but it looks like we'll leave state aid rules. Actually, that might be helpful, especially if you go in a sort of Singapore direction. All the obvious stuff, we no longer have to sort of favor EU industries. We can favor UK industries. We may lower taxes more because we're restricted from doing that at the moment. We're considered as competitive as they will allow. Again, maybe we'll go Singapore direction. And probably the badder ones who were leaving the concept of harmonization of taxes. So they were really trying to get everyone on a level playing field, if you were, in regard to avoiding sort of companies not paying tax, like Starbucks and stuff like that. We are quite hot on that. And there's something called DAX 6 and stuff that we're very much part of that Ian will mention. But that's it. Almost all our law is our law. All of our tax treaties are our tax treaties. There will be some technical effects on people's product compliance in terms of labeling and things, but that's pretty much it. I now hand over to the very good Ian and Jemma.
Thanks, Andy. So the first property update I want to mention today is what is effectively, sorry, can I have the first slide? The most radical shake-up to the planning system that we have seen in the last 30 years. So the government has replaced the majority of the standard commercial use classes with one single use class. So shops, offices, restaurants, cafes, gyms, amongst others, now all fall within a single new use class E. This new use class is very flexible. It allows for a mix of uses to reflect changing retail and business uses. And it means that the same premises can be used, for example, as an office during the day and then a restaurant during the evening without needing planning permission. For others who might have a showroom, which at the moment is usually classed as an office, you can now use that as retail instead without needing planning permission, which is great. It's really welcome use. But there are other factors that occupiers should consider before taking advantage of the new flexibility. So in particular, check the terms of your lease, as they often restrict use to one particular use, such as offices, for example. Most landlords in the current climate probably will be prepared to be flexible, but it's something you need to raise with them. The other thing to consider is any restrictions that might be contained in any existing planning permission, because these will continue to bind the property. So if you do have a restriction in an existing planning permission, you will need to apply for a new planning permission. The second temporary measure that was recently introduced that will help hospitality businesses relates to pavement licenses. These have become easier and quicker to obtain. They allow businesses to serve food and drink to customers outdoors. Under the new process, the license application fee is capped at £100. And if the local authority doesn't determine the application within 10 working days, then the license is deemed to have been granted automatically for a year. We've already seen the benefit of this with a lot of restaurants and bars being able to use pavements to extend the capacity of their restaurants and bars, which is of course crucial if they're going to be able to operate in a socially distanced manner. It might be a little bit more difficult now. We're getting to winter, but we've always got outdoor heaters, which will be great. I've got one last point. My third commercial property point is that the UK government recently announced an extension to the COVID-19 protections for commercial tenants until the end of the year. So until that date, landlords will continue to be unable to forfeit a lease for non-payment of rent, and they will also be restricted from serving stat demands or winding up petitions on tenants who have been unable to pay their rent as a result of COVID. While this measure will undoubtedly provide some relief for tenants, it is important to bear in mind that the rent and interest on it does continue to accrue and will become payable in time. So I would recommend reviewing any rent concession agreements already in place, and also try to negotiate a new payment plan, bearing in mind this latest extension to the end of the year. I'll now hand over to Ian on residential and tax changes.
Sorry, just unmute myself. Thanks, Jemma. The first thing I wanted to flag was temporary reduction in stamp duty rates. This is to kickstart the housing market, and it has done so without a doubt. So basically, there's no stamp duty at all on the first £500,000 of a purchase for a residential property, if that completes before the 31st of March 2021, which is a massive saving. And interestingly, even if you're a second buyer, investment property, buy-to-let, landlord, that concession helps you as well. You still have to pay the 3% higher rate, but you don't have to pay any additional stamp duty on that first money. So I've got a client who's about to buy a flat. The difference for him is if he completes before the 31st of March, is he's going to pay about £2,000 in stamp duty. If he leaves it till after that, it's going to be about £20,000 of stamp duty, which just shows how significant that number is. The other point I wanted to raise, which seems to have got forgotten amongst all the other madness, is that there is published draft legislation to increase stamp duty for overseas buyers, an additional 2% surcharge from 1st of April 2021. So I think the key takeaway here is if you are looking to buy UK property, UK residential property, and you're from overseas particularly, definitely think about getting it done before the 31st of March, because there is a massive difference. There's at least a sort of, could be up to sort of 7-8% difference in stamp rates. Big savings for you. Next slide, please. Another thing that seems to have gone slightly under the radar is that we are now in a new regime where any disposal of UK property, UK situated property, commercial, residential, or even mixed use, has to be reported to HMRC, our tax authorities, within 30 days of disposal, and the tax has to be paid if there is any capital gains tax to pay on that disposal. It must be reported even if there's no tax or you've made a loss. There's a penalty for not reporting it, which is up to £600 or 5% of the tax due, whichever's greater. And obviously a 5% surcharge on quite a large gain makes a big difference. So please be aware of that. Sort of in tandem with that, there's also changes to what's known as our principal private residence exemption, which is if you're selling your own house, it's effectively tax-free. There's massively complicated rules around what constitutes your own house. It used to be that the last 18 months of the occupation period, no matter what, as long as you'd occupied it at some point, would count towards that being a private exemption, but it's now restricted down to 9 months, the last 9 months. So that's something that's catching a few people out. There was also some relief if you had let your property during the time you owned it, but that again has been quite severely restricted. So again, there's less reliefs available there. So the government are very focused on capital gains tax on UK residential property. There's a sort of double whammy. The other thing I just want to mention briefly is property-rich companies. If you share sales of companies that have got 75% or more of their value from UK property are also taxable, and that's true whether the company that owns that is based in the UK, overseas, whether there's 5 intermediate companies between that company and an ultimate ownership in Switzerland or wherever it may be. That is an absolute need to make a tax return to the UK. How they're going to police that and how they're going to spot these things, we have no idea, but that's the rules. And if it's the only disposal you make, you have a duty to make a tax return covering 1 day, and any tax due is due 3 months and 14 days after. Next slide, please. I think that's it. Actually, I'm going to hand over to young Rachel to talk about auditing.
Hi. So what companies need an audit? Any company who on its own, or if it's part of a group, it's assessed on a worldwide basis to determine if a UK entity needs to have an audit, breaches 2 of the following criteria. So turnover more than 10.2 million, gross assets more than 5.1 million, or employees more than 50. There are certain other specific requirements for regulated and listed companies, etc., but those are the key ones. Next slide, Andy, please. So going concern is causing a problem, unsurprisingly, in the current climate of COVID, with a lot of sign-offs for audit reports. The ICAEW, who are our regulators in the UK, have been frankly far more stringent than any other country we've come across in regards to the level of comfort that they are requiring UK auditors to get to in order to sign off on going concern, which is in itself causing problems. It's meaning going concern assessment can take longer, can therefore cost a bit more. And in order to make sure there's no delays in sign off, either for filing deadlines or internal deadlines, that it needs to be planned for to allow enough time for that to take place. And there's also far more likely to be some wording in the audit report relating to going concern. So that is not the scary thing that it used to be. It's currently expected that around 75% of UK audit reports will have some wording in them relating to going concern. And the kind of options, if you end up down that route, are emphasis of matter, which is really a super light touch approach. It generally means the auditor's pretty happy with everything. There's a few things that are uncertain, unsurprisingly, in the current market, or that they're unable to get enough support behind. Maybe contracts aren't yet signed or something, but it's not a big deal. There's material uncertainty with respect to going concern, which generally means that those uncertainties, it might be the sector that a company operates in or the level of unsigned contracts, etc., are higher and are making that question mark around going concern just slightly bigger, or there's disagreement where the auditor's just unable to get satisfied about going concern. Next slide, please. So many things that all businesses, or most businesses, will have been doing historically and using to run their business, but perhaps have not been used to sharing with their auditor, now need to be looked at and evaluated as part of the going concern assessment. So be ready to share and discuss these. So forecasts, sensitivity analysis, cash flow forecasts, support for the numbers in those forecasts, and support for funding. And if a UK company is basing its going concern on support from a parent, then we'll need to look up to that parent level as well to make sure that that parent is okay. So in conclusion, do what you have been doing, produce all of that information, but be ready to discuss it with your auditor from the off. Bring them up to speed as quickly as you can and in as much detail as you can. Understand where they're coming from in this high level of satisfaction that has to be met, and work with them to come to the best possible outcome you can for your business, bearing in mind that an emphasis to matter is not the end of the world as we knew it. And now I will hand over to Andrew and Jemma on private affairs.
Thanks, Rachel. So sadly, one of the things that the coronavirus pandemic has highlighted is the importance of preparing now for later life. Currently, about 2/3 of people in the UK do not have a will or a lasting power of attorney. And so we thought it would be helpful to just run through a few of the things that we think everyone should be thinking about at the moment. Firstly, do you have a will in place for your UK assets? And if so, has it recently been reviewed to check both that it minimises inheritance tax liability and that it continues to reflect your wishes? We fully appreciate that many people are currently shielding or vulnerable, and so we're happy to speak to you about your will over a video call. Legislation has also just come into force that allows wills to be witnessed remotely over a video call, which will make it much easier for social distancing to be maintained while making your will. If you don't have a will in place, intestacy rules would apply on your death. I'm not going to go into these in too much detail, but they often result in more inheritance tax being payable than would be the case if some tax planning had taken place when preparing your will. The intestacy rules are often unsatisfactory, particularly if you own business assets that you would like to be left to someone other than your spouse or children. As part of your estate planning, we would look at the terms of any existing shareholders agreement or partnership agreement that relates to your business and ensure that the terms of your will match up with these so that you have peace of mind that your business can continue to operate should the worst happen. One last point to just mention on wills is that they tend to be jurisdiction specific. So even if you have a will in place elsewhere in the world, it doesn't hurt to check whether you need a separate one for your UK assets. Next slide, please. A second housekeeping point is just to think about having a lasting power of attorney. There are two types of lasting powers of attorney in the UK. One that allows someone else who you trust to make financial decisions on your behalf, and the other that allows someone to make medical decisions for you in case you ever can't make those decisions for yourself. Many people often think that their next of kin automatically has a right to make those decisions, but you don't. If you don't have a power of attorney in place, if you don't have a financial lasting power of attorney in place, then your assets would be frozen if you lost capacity. Even a joint bank account that you might have with your spouse could be frozen. And then an application to court would have to be made, which is expensive and time consuming. So it's just, I really do recommend having at least a lasting power of attorney in place. Similarly, without a healthcare lasting power of attorney in place, it would be a doctor who would be making important medical decisions on your behalf instead of your next of kin who you've probably had these important conversations with. Next slide, please. One final point that I just wanted to mention is how useful wills and tax planning can be to protect your assets and ensure that your family is provided for in the future. For example, we can set up a trust within your will that would protect a share of your family home from being used to pay for care fees. We can also ring fence a part of your estate so that whilst your spouse will have a right to income from your estate, the capital will always be protected against things such as bankruptcy or a second marriage, and would ultimately be inherited by the people that you choose in your will. I'm now going to pass over to Andrew, who's going to discuss some key things to think about regarding financial planning.
Hi, thanks, Jemma. So just a few points from our side on the financial planning team. We work quite closely with Jemma, obviously, with her legal planning for individuals, and that ties in with some of the points I've put here, starting with life cover. You know, going into this pandemic, we had lots of questions from clients about their existing arrangements. You know, do we have sufficient cover in place for our family to cover those kind of what if scenarios? The cover that we do have in place, is it set up correctly? Things like putting the policies in trust so that the money goes to the right people at the right time in a speedy manner, and it also means that those benefits are paid tax efficiently. You know, don't form part of your estate for tax purposes. So reviewing your life cover arrangements is obviously a key priority. People often think about their personal financial arrangements as a priority. Is my mortgage covered? Is my car loans covered? Do I have cover for childcare, etc.? You also need to be thinking about any business liabilities that you may have in place if you're an owner. All of these business loans, etc., that may have been taken out over the past few months, are they adequately protected? So life cover being an obvious point to review. Excuse me. Alongside that, then, do you have arrangements in place if you're unwell, if you have a critical illness, or if you have another illness, which means that you're unable to work and therefore your income stops? So just simple points here about reviewing protection arrangements for you and your family. Final point here on pension benefits. People often forget about pension assets, but often they are quite a sizable asset of part of your wealth. Do you know what would happen to your pension arrangements on death? In most cases, those benefits would be paid as a lump sum to your family members. But have you put in place an expression of wish, which means that you've got a piece of paper that sets out who you'd like that money to be paid to if the worst were to happen? So again, a review point there for your pension arrangements. To remind you, most pension assets are going to be free from inheritance taxation, given the way that they are set up. So again, clients with sizable pension assets, is it sensible to be drawing down on those assets, or could you live off other assets in retirement and possibly defer drawing on those assets, given that it's a possibility to pass on those assets in a tax efficient manner? So again, a review of pension assets is key and certainly something we could help with. Final point in terms of funding of pension arrangements. We've seen over the last few months, there's a lot of money floating about from government to get us through this crisis. At some point, we're going to have to balance the books. And again, as we come to every budget, there's talk about the tax breaks on pension funding possibly being watered down. That's a kind of key point, I think. At the moment, the funding of pension arrangements in the UK is particularly a tax efficient question. Is those tax breaks going to be watered down in future years? Is there an argument to fund your pension sooner rather than later and make use of those tax breaks? So a few obvious points here really that you should be reviewing as part of an ongoing financial health check. And of course, we're happy to help with a lot of that. So that's it for me. Handing back to Mr. Ian Phipps on some final points.
Thanks very much, Andrew. A few final points. I think I'm covering the entire tax system in probably 3 minutes. I'll try and keep it to 3 minutes. Some very technical things. So I'm going to cover this at a really high level, but just to sort of have so you've got some ideas and some thoughts, might trigger a few alarm bells if you're in these situations. So the first 2 points are really connected. If you're doing group reorganizations, if your companies are moving groups backwards and forwards, or transferring companies between group members, there are HMRC typically ask for a clearance to say there's no taxes to pay if it's all intergroup. They're being particularly awkward at the moment, even on very simple things. Just inserting a holding company over a trading company for some asset protection or whatever is even those are being challenged, which is bananas. And staff have been changed at HMRC recently. The person who used to sort of run it, who was pragmatic and half sensible, has left. So there's bright new young things in there trying to make a name for themselves and causing chaos. That's combined with change in stamp duty. So again, reorganizations within a group, typically you could make the cost of shares, if you're issuing shares as part of that reconstruction, you could put whatever value you liked. That's now changed, and you have to put a market value in for stamp duty. It's 0.5% stamp duty on any share transfers. So it's just an extra cost you have to bear in mind. There is a new market value rule. Working from home in the pandemic is one of the things that problems being created is beware of creating a permanent establishment. I'm sure Most business owners out there are very, very conscious of this, particularly if they're trading internationally, that if you have people working in a country, then there is a risk. Each country has different rules for what constitutes a permanent establishment. What you can do if your employee's suddenly working at home 6 months in, say, Spain, is, that could trigger certain permanent establishment rules in that country. It could mean that you may need to register for payroll taxes in that country. So just please be conscious of that if you've got people on long-term working from home arrangements across border. Also, employee claims, HMRC have clarified, obviously being very helpful as ever, that if an employee has a choice to work at home or not, then they cannot claim expenses from their employer from working from home, i.e. gas, electricity, phone calls, etc. So it has to be the employer's told them to, so they are being made to work at home, so there is no choice in the matter. Then they can claim a basic some of their costs against their tax. Next slide, please. Statutory residence test is now a sort of legislative test for whether you're a UK tax resident. There are some exemptions. Obviously, it's a question of day counting. For example, if you're here for 183 days in a tax year, you're resident no matter what. There are some sort of exceptional circumstance exemptions. So you can be here under exceptional circumstances and those days don't count. There's a limit, an annual limit of those days of 60. They have accepted that COVID counts as an exceptional, but any days over 60 will still count as a day of presence. So if you're stuck here because you haven't been able to travel back out of the country, and you've been here for more than 60 days under the COVID exceptional cases, those will start counting towards UK tax residents. Beware. Andy alluded to DAC 6 reporting earlier. This is a major tax compliance thing, huge headache for professionals. Basically, what has to happen in any cross-border transactions where you're giving structuring advice to clients, it could be commercial advice, could be tax planning, whatever. But if there's a tax implication and a tax benefit, that has to be reported to HMRC, to the tax authorities. This is across Europe. Reporting. So the rules are slightly different in each country, but effectively anywhere in Europe, this legislation is coming in. Well, the legislation's in, the reporting starts next year, early next year, but it covers transactions from as long ago as 2018. So if you've been involved in a group reconstruction again, or if you've been involved in some planning between should we be trading in France, versus Germany versus UK, and you've got structures in place, the chances are those arrangements will need to be reported to a tax authority somewhere in Europe. Entrepreneurs relief, as was, now business asset disposal relief, much more. I still prefer entrepreneurs relief. Just a couple of quick changes to bear in mind. It's now limited to 1 million of gains over the individual's lifetime, and now requires a 2-year period of ownership. It used to be a 1-year period. So again, they're being a bit more restrictive and careful if shares have got no voting rights, because there's a recent case and you need to have 5% of the voting rights as well as the share capital. Final point from me is off payroll rules. It's been, it's gone, it's been, it's gone, it's come and it's gone. But in theory, it is coming again in April. So this is where if you're a large company, and those definitions a simplified version is in the bullet point below, so you can see what that means. If you have contractors that are employed through their own personal service companies, then if the relationship really underlying this is one of employer-employee, then you'll be responsible for operating PAYE and for accounting for PAYE on their salary, whether they're employed through a personal service company or not. If there's an intermediary, so an agency provider for contract workers, and they're large, they will have the responsibility, but it could still ultimately land on your door. So that's shifting the emphasis completely from the PSC itself up to the employer in quotes. Just one thing to clarify, if you're a wholly overseas business with no UK tax residence and no UK permanent establishment, these rules don't apply to you. So obviously if you're employing someone with a PSC from France, for example, then the rules don't apply to you. The responsibility will stay with that PSC. So that was a quick rush through, hopefully not too long. I'll hand back to Simon for roundup.
Great, thanks Ian, and thanks everyone. We've been pretty good on time. We're bang on an hour. I think we've got a number of questions, so thanks everyone for submitting questions. I think we've probably got time for one or two, and then as I said at the onset, we'll, if we don't get to your questions, we'll provide answers probably tomorrow following this afternoon's one. So the first one is one for the accountants. There's a question about PAYE deferral, and have there been any overtures, or are we aware of any changes or extension to rules in relation to PAYE deferral as a result of COVID?
No. I mean, you could agree with them deferrals. You can try and agree what you want with them, but yeah, they're pretty hard to get through to, and not that flexible about it, I would say, these days. If you beg them enough and put together a payment plan, perhaps, but there's been no further announcements on it. And do watch out if you're doing R&D claims, they'll take the money out of your R&D claim. So you may think, oh, I've deferred my PAYE and I'm going to get this R&D cash. You won't. The R&D cash just won't turn up. So it's a bit tricky, that.
Great. Thanks for that, Andy. Juliet, just one or two for you. Question is a sponsor license for existing employees from the EU as well as new ones?
So there isn't a need to have a sponsor license if there are Europeans here and they've applied for settlement. It is post the 31st of December. So from January onwards, if you get new employees, it is likely you'll need to sponsor them if they're European.
Great, thank you, Juliet. And then Ross, final one just for you is, can you use the new job scheme for board directors who are paid through PAYE?
Yeah, there's no reason why not, unless they provide further guidance exempting directors. They're employees if they're on the PAYE. So yes.
Okay, that's great. Very conscious of time, and once again to everyone who participated, thank you. We will follow up with questions, and as I said at the beginning, we will make the slides available to you, and a recording of the webinar will be available on YouTube, and we'll find we'll send all of those details to you in the next couple of days. For those of you starting your day, have a great day. For those of you ending your day, enjoy your wine or beer when you get there. And thanks everyone for participating. And thanks all panelists as well.
Thank you.
Cheers, everyone.
Thank you.
See you all later. Bye.
Ciao.